Now that is just a rough estimate of how many tons and what its average grade is. Then the project goes to the infill drilling stage where they increase the density of drilling and they increase the resource status from inferred to measured and indicated. And as they start feeling really comfortable about that the size of the resource is large enough to go for a mine, they start working on that problem of recovery, doing a bulk sample, doing metallurgical studies on it to determine, well, what do we have to do to get the metal out of the rock? And when they've got all that taken care of, well, then they start really rolling up their sleeves, and that's when the project goes to pre-feasibility. And the pre-feasibility stage spends the most amount of money, because then they take the resource estimate from measured and indicated to proven and probable to a mining reserve, and that means very detailed engineering, very detailed drilling, and it's actually the most tedious part of the exploration cycle. Well, perhaps not the most tedious part. The most tedious part is when pre-feasibility says, yes, this can be a mine, the economics are good, now we need to permit it. The permitting cycle defines what funny things you need to do to make the environmental regulators happy, to get a social license from the Aboriginal groups. All these little details go into determining the feasibility of a project. There's not so much work, physical work done during the feasibility study as there is number crunching and engineering and other sort of negotiation type studies. And once you have a permit in place, well, then you need to raise the money. Assuming the project is still feasibility and a production decision is made. And construction can take several years. And then there's the commissioning where we need to see everything actually works. And then finally, a mine is in production. And as you can see, this can go anywhere from about 6 to 10 years from start to finish if everything works properly. Now, another important concept is that of the probability ladder. As the project moves through this exploration cycle, the outlines of the outcome become more and more clear, the failure risk declines. So you can see if you're shooting for a $500 million dream target at grassroots, your chance of delivering that is less than 1%. And of course, once you're at the permitting and feasibility stage, you already know so much about the project that your chance of getting to the finish line is 50 to 75%. But the important thing is this progression here. This probability ladder is key to the rational speculation model. And here are other ways of expressing probability as leverage. And leverage is a nice number because when you generate that number, that gives you an idea of how much you multiply the stock price by that number, and that gives you a sense of what you might end up, where the stock price might end up with if the company completes the exploration cycle. So the final stage is to do the risk-reward analysis. And we've already figured out what the appropriate dream target is. We've calculated the implied project value based on current market price and issued stock. We've figured out what exploration stage they are at. Now we have to plot it onto this IPV chart, which was this fancy graphic that I showed you earlier on. But before I do that, we need to review a core concept, a core gambling concept. And most people intuitively understand that a fair bet is one where if the intrinsic odds are 10 for 1, it should pay 10 for 1. A poor bet is one where, say, the intrinsic odds are 10 for 1, but it's only going to pay 5 for 1. And the good bet, which everybody is always seeking, is where the intrinsic odds might be, say, 5 for 1, but it will pay 10 for 1. And I hate to encourage gambling, but I think every youngster should at least once go to the horse race track and see how that works, and just see how the odds change as people place different bets, and then watch the payouts. You don't have to do it, but I think for life it is essential to understand racetrack betting in its core, because that is what risk-reward analysis is all about. Now, in our sector here, where I'm interested in, the resource sector, with publicly listed companies where they are trying to find or create a mine, we talk about speculative value, not gambling value, and the same concept arises. We are betting on different outcomes, and we are assessing the underlying odds of that outcome being delivered, and we are calculating how much money we would make, and if it's in determining whether it's a fair bet, a poor bet, or a good bet. And here's how we map this probability ladder to this scenario. As you can see here, the various stages, you can see the probability of it going from here all the way to here is quite low here. If we take the different dream targets, say the $100 million dream target, a project which is in the game for a $100 million dream target should have an implied value of less than $1 million. But if a strong case can be made that this is a world-class play that could end up being worth $2 billion if it becomes reality, then we might justify a $10 to $20 million valuation at this early stage. And you can see how the progression increases as we move towards the final outcome. So here is a blank IPV chart showing the fair value channels for the different outcomes, 100 million, 500 million, and $2 billion. Now let's switch to a chart where we have actually added real projects at this particular point in time. And the one I want to draw your attention to is the star, which is the implied project value for Brett's Hammond Reef project, sitting here in the bottom part of the yellow $500 million dream target channel. Now, just looking at this chart tells me that, okay, the market is saying, assuming the market is efficient in its analysis of this company's potential, the market's saying that $500 million is a reasonable dream target for this company, and owning it now gives you fair speculative value. If the market decided, or you decided based on your analysis, that the project was potentially worth $2 billion because you think they're going to discover another 10 million ounces with perhaps a higher grade, well, then you would say it belongs in this blue channel here, which is the $2 billion dream target channel. And if the market started to believe that, you would see the blue star move up. It's at the metallurgical stage of the exploration cycle right now. It would move up into this range where it would be assigning it a value of, say, $200 to $300 million. In other words, the stock price would go up about 5 to 6 times. So what we are always doing in this market is we're always assessing, is the project ready to move to the next stage, or what sort of target outcome is the most plausible for the moment, which is why news releases are always a major event, and analysts swarm all over it and analyze it to see how does it change our expectations about the outcome. So if there is a dramatic change, for example, we discover as a result of metallurgical studies that recoveries are only 20%, well then definitely this company is no longer in the yellow channel. It's perhaps at best in the $100 million channel, and the market would price it substantially lower, and you would see the star drop down to this level. On the other hand, if the metallurgical study says, yes, 90% recoveries at a reasonable cost, no special complications, we're now going to pre-feasibility, then this star would move over into this pre-feasibility slot. And if the price did not change, say the market was still pricing it at 52 million, well, you would see that it is well below the yellow $500 million dream target channel. So this would be the signal to price the stock higher, and investors would go into the market seeking to buy it, because you would then see this project move over and adjust back into the yellow channel, where it might be here at maybe 2 or 3 times the current level. So that is why these milestones